Yes, hi, good afternoon. Welcome to our webinar this afternoon on charitable plan giving. We appreciate you taking the time to join us as we learn on this very pertinent and important topic. My name is Nancy Froman. I'm the Director of Development for the Foundation for Peripheral Neuropathy, and I will be doing some of the background work, and I'm joined by my colleagues, Lindsay and Tanya. Before we begin, just a couple of housekeeping notes. This presentation is being recorded. We will send you a recording, a link so that you can watch this at your leisure at another time. You can also submit your questions at any time through the question box on your screen. We'll be collecting those questions and directing those questions to our speakers at the end of the presentation. And if you're having trouble with the audio, you can dial in by phone. You can get that number on the email that was sent to you with your registration. I would love to introduce our three speakers to today. First, Lou Mazawey resides in Arlington, Virginia, and has practiced law his entire career with Groom Law in Washington, D.C. Groom is the largest employee benefit law firm in the country, and Lou has been there for more than 45 years, working on a variety of matters related to the tax aspects of employee benefits for Fortune 200, tax-exempt, institutional, and state and local government clients. In 2003, Lou was first affected with PN, a form of PN referred to as anti-MAG. He is managing his illness, and is currently also funding research focusing on PN patients with anti-MAG. And lucky for us at the Foundation for Peripheral Neuropathy, he serves as the president of the foundation, for which we're exceedingly grateful. Mark, who's also one of our speakers today, is the senior vice president with a wealth management advisor for Merrill, for Menick, Friese, Phillips, Bock group in Merrill Lynch in Washington, D.C. Mark has helped clients plan for their financial future since he joined Merrill Lynch in 1987. He is a frequent speaker and has conducted seminars on financial strategies, education planning, tax planning, legacy planning, and estate plannings for many institutions, corporations, nonprofits, associations, and the like. Mark has worked with many nonprofit boards on developing a cohesive and holistic plan for their financial needs, and also has served on the boards of several nonprofit companies. One of Mark's most rewarding passions is to help his clients think beyond their lifetimes and to work towards the message they want to leave behind. This includes education on plan giving strategies and intergenerational wealth transfer. And Mark has worked with us at FPN to understand charitable giving and has offered his advice and services to us and our constituents. Dan Ruttenberg is our third speaker, and Dan is a principal with the law firm of SmolenPlevy in Tysons Corners, Virginia. His practice includes succession planning for businesses, general corporate law, estate planning, and estate administration. Mr. Ruttenberg is also a frequent speaker and frequently interviewed by the media for his insights on legal issues, as well as estate planning and business for individuals and tax planning for businesses. He also has a role as the president of several bar associations, and is also a member of the board of directors of Donation to Children, a charity which promotes access to high quality education and childcare services for children from economically disadvantaged families. We are truly honored to have the expertise of this panel here with us today. And I turn it over to Lou to start us off. Very quickly before we turn it over to Lou, we have today's agenda that we'll talk to Lou first to give the donor's perspective. Mark will talk about donating structures. We'll then have Dan giving us some updates on the tax law, followed by a Q&A, and I'll come back to give you some ideas of how you can give a plan gift to FPN. And with that, Lou, I really turn it over to you.
Yeah, thanks, Nancy. Thanks very much. So it's welcome everybody. We appreciate your dialing in to our webinar. It's only about a month before tax time, so presumably folks are even thinking more about what they should be possible donations, tax planning, and the like. So it's we hope you get a lot out of it. So as Nancy mentioned, I've had PN since 2003, a long time. It's progressed very slowly, like most forms of peripheral neuropathy. Mine had an unusual cause. It's an autoimmune cause called anti-MAG, which has to do with, it's a very long medical term, which I won't bore you with. But it's unlike, most folks that have PN have, as a result of type 2 diabetes or chemo-induced, or many times they don't know why they have it. It's idiopathic. But in my case, we know, and it's a fairly rare situation. It has progressed slowly. I have all the symptoms of that, that are commonly associated with PN. So the numbness, the pain, the balance issues. I have a significant muscle weakness, and again, all in the ankles and feet. And so it's a challenge, but I'm after all these years, I'm still able to do my daily activities, and I'm really fortunate to do that. And I've had good medical care. So I have meds to deal with the pain and, mainly the pain symptoms of it. And in 2016, I was pleased to be able to join the board of the foundation. And soon thereafter, the way things worked out, I became the president. And as you know, the foundation is a very small tax-exempt organization with a very big mission. To help, given that millions of Americans, we estimate 30 million, have peripheral neuropathy, we're trying to do a lot of things. We're trying to enhance awareness, understanding of the disease, and of course, develop cures through research. So all those things that as part of our mission, take funds. And for the funding, we depend primarily on donors like you. And we appreciate all the support we've gotten from donors. And, we wouldn't be here without our donors. And so hopefully, and along that line, we thought this program would be a way to review different ways people can donate, and for tax and other reasons as well. And we know that tax law is a moving target, so I think it's helpful. We did this program last in 2019, and since then there have been changes, and there are proposals for more changes, so it's good to revisit. And Mark Friese and Dan Ruttenberg are two professionals that I've worked closely with for a number of years on my own financial and estate plan, and they're both extremely knowledgeable and great people to work with, and we appreciate their joining us today for this program. So with that, I think I will turn it over to Mark Friese to review some of the techniques for giving. Yep.
So good afternoon. Thank you guys for listening. Thank you, Lou, for the introduction, and Nancy. I've been working in the nonprofit area for a long time. My profession is doing financial planning for clients, but in many of those conversations, we talk about next generation planning, we talk about planned giving, we talk about what's the message going to be. You were living your entire life, and is any part of that in your DNA going towards nonprofit organizations? In the past, most people just wrote a check. They went to a gala and they wrote a check, and that was simple to do, and they were able to itemize it on their taxes, and that was all good. they've changed the tax laws recently. So itemizing on your taxes for about 85% of America does not happen. The standard deduction for married people is $25,100. So if you don't eclipse that number, you're not able to deduct or itemize and deduct that contribution. So today we're going to talk about what do you do? What are some other options? What are some things where I can still support the organization and receive a tax benefit? So I'm going to go over kind of a list of those things very simply, and we'll kind of talk about each one of them. The first one is, as I'm speaking today, stock market is very close to all-time highs ever in the history of the United States. So we're all hoping for vaccinations. We're all hoping to get back to a regular life and to be able to travel and visit and do things like that. We also look in our brokerage statements and realize that things are appreciated a lot. And under the current rules right now, if you have a stock and you sell it, you have to pay a capital gain on that stock, and that's anywhere between 20 to 30%, depending upon your tax bracket. But if you donate that stock to a nonprofit organization, there is no tax. So you get to give the full benefit of the donation, but you don't have to worry about the capital gain. So that's a very simple way to do it. It benefits you because you avoid the capital gain tax, and it enhances what Peripheral Neuropathy Foundation can do. So that's awesome. So those are two good things. The other area that's open right now, and people thought about it a lot, are IRAs. So many people have IRAs. About half of America has an IRA or a 401k or a 403b if you're a nonprofit organization. And those are great accounts to have. Money is deferred from taxes until a certain age. And then once you reach that age, you have to start taking money out based upon your life expectancy. And when you take it out, it's taxable income to you. So a lot of my clients don't like that. They wish they didn't have to pay the tax on it. They're really deferring that money in many cases for the next generation or charitable organizations they want to support. And so one of the things that's new in the tax law is up to $100,000 of your mandatory required distribution can be used towards charity. So you can give it to a charitable organization, and then it doesn't count as earned income for you. So that's a much better way to do it. So I tell my clients every day, don't write a check to an organization if it's a large check. Call me first. Let's have a conversation about some of the other options. The other thing you can do is called bunching. So if you don't have enough that you're going to make the standard deduction as a married couple, which is $25,100, you can bunch your contributions together. So let's say you want to make a contribution of $75,000. You could do it all at once instead of dividing it over $25,000 each year as an example. So that's called bunching. That's another good way to you would exceed the standard deduction, so then you would itemize, and then it would be tax deductible for you. So that's also good. So those are the main things you can do now. There are also some things you can do later. We call it, current donations. So those are simple to do, and some of them are very easy. So on a simple one, you might just do the techniques we talked about. But the other part of it might be to take a look at legacy giving. So that's, after you're gone, what's left over, what might be passing on to the next generation. Those are easier gifts to make because you're not going to be around anymore, right? So you won't have to worry about whether you can support your husband and your wife and your cash flow and all the things that you want to be able to do. It's kind of the residual that's left over. And there are some simple ways to do that. Most accounts that are beneficiary driven are excellent accounts to kind of follow in that path of giving. So an IRA, you might just change your beneficiary designation and put the Foundation for Peripheral Neuropathy on there as one of the beneficiaries of it. The reason that's so important right now is because, of course, that money is taxable, as we've already talked about, but they also changed the tax law for how long you can defer it. So under the new rules right now, it used to be that you would be able to defer the tax over your entire life if it's an inherited IRA. So you pass the money on to your kids, they inherit the money, they have to take a little bit of money out each year based upon their life expectancy, but the tax liability is deferred over many, many years. So that changed, and so the new law is that that particular account has to be empty within 10 years. So you have compressed tax rates, you have to make some big decisions, you have to go see professionals to make sure you're making the right decisions. But all those things, mean that IRA money is not as powerful for your kids as it used to be, and it's a great place to put a donation to a nonprofit organization that you believe in. So that is definitely another way to do it. Other ways, you can change beneficiaries on your insurance policies. Those are all simple ways. You don't need to go see an attorney to do any of these. Simple ways to support the organization. and know that the money will be there because you've planned for it your entire life. So those are some of the ways that we can think about. One of the questions that a lot of people have is, do I have enough to do that? And so as a financial planner, I always call it the magic number because it sounds interesting and fun. So what is the magic number? The magic number is if you do the proper planning with your financial advisor, and what's left over. And if you look at it nowadays, for lots of our clients, that number is a very large number that's going to be left over because the stock market's done so well. And so because of that, you start thinking about, do I really need to leave, my one child, $15 million or $12 million or $10 million or whatever the number is? Or, could some of that money go to a nonprofit organization or organizations that I believe in? So those are all different methods. The magic number kind of helps you figure out what's going to be left, and then you can make a better decision. In my practice, I have a couch in my office, and we sit down in there, we talk about it. We talk about kids, we talk about what they need. There are 100 books written about this subject. Don't leave too much because it sometimes affects people in a negative way financially. And so giving back to nonprofit organizations for many of our clients is something that comes natural, and we'll also want to pass it on to the next generation. So those are some of the main points I wanted to cover today. I'm going to turn it over to Dan Ruttenberg. He's going to talk about some of the legal ramifications and some of the other things tax-wise that can help you.
Thank you, Mark. Excellent. Excellent information. So Mark talked about, some of the things actually that have recently changed. There's been a whole lot of acts that Congress has passed that impact charitable giving. There's the Tax Cuts and Jobs Act that happened in 2017. There was the Secure Act and CARES Act, and there's probably a new one coming down the road. What I think a lot of you are familiar with now is the Tax Cuts and Jobs Act made it, as Mark said, much harder to itemize, and that's really impacted a lot of charitable giving, because it used to be you gave money to charity, and as long as it wasn't hugely large sums, you got to deduct that money. And then they changed it, so they made it harder to itemize, and as Mark said, 85% of the people aren't itemizing anymore. They're taking the standard deduction. And so there wasn't a tax benefit to doing charitable gifting. And while that's not the only reason people give to charity, it certainly impacts how much they give. We started looking at ways, well, how can you give money and still take advantage of, get a tax benefit? And as Mark pointed out, one of the things they did is with the Secure Act, they came out and said, hey, you can now donate from your IRA, your minimum required distribution, up to $100,000 a year. And so if you were deducting, that doesn't matter. And if you're still deducting, and some of you probably are still itemized, doing itemized deductions, this doesn't really matter so much unless you're hitting the upper income tax limitations on charitable gifting, which I'll talk about in a minute because that was addressed by the CARES Act. But for most Americans that donate, they're able to, if you're itemizing, then if you donate from your IRA, well, it's income to you, but you get a corresponding deduction. They came out, though, for the people that aren't itemizing, if you've got a minimum required distribution, you can up to the $100,000 donate to charity. And so that's a great way to do that. And one of the other changes they made was they changed the age at which you have to start taking your minimum required distribution from 70 and a half to 72. However, you can still do the $100,000 contribution at 70 and a half. So you don't necessarily have to be doing your required minimum distribution in order to take advantage of that. And as probably most of you know, last year, you didn't even have to do a required minimum distribution. They suspended that for a year. That is not currently the case for 2021, but we got to take advantage of that for 2020. So that's what the Secure Act, that's the main thing the Secure Act did. And then the CARES Act came out and made a few more changes. Now here, again, they made it a little easier. One of the things they did is they allow you to donate $300, and that doesn't matter whether or not you itemize or not. You can just donate $300 to FNP and take a deduction. In fact, one of the changes this year is if you're married, they up that $600. So it's $300 for single, but $600 for married, and every dollar counts. So that is a simple donation that you can just do regardless as to whether or not you're itemizing. They also, this is where there's probably most people don't know this, because when you donate money, you think, hey, I get to deduct it. And you hear on TV or something all the time, this is 100% deductible. Well, technically, things are only deductible up to a certain amount. You can't deduct in most cases 100% of your income. So if you earned $200,000 and you donated $200,000 to charity, generally speaking, you don't get to deduct all of that. You can only deduct a certain percentage, and different percentages depend on what you're going to. But to a regular charity where you're donating cash, that number is typically 60%. One of the things that's changed is in the short term for last year, and they've extended again this year, you can donate 100% of your income. So if you did want to make a large distribution out of your retirement account, this is to charity, this is one of the years you can do so, because while that does come in as income, you get a full deduction on that. So there are some opportunities for large gifts to be made out of retirement accounts this year in particular that are probably not going to be around anytime soon. So those are the big changes I think that the acts did. And then I think we all expect some changes to come. We've had a change in political regimes, and Joe Biden has said what he wants to do. We haven't seen any real proposals. Some politicians have put forth some smaller things, but we haven't seen his major proposal. But he has stated that it's likely to come as part of the next stimulus package associated with COVID relief. There is likely to be a major tax change at that point in time across the board. There's going to be likely Social Security tax increases for anyone making over $400,000 a year. There's going to be increases in corporate tax rates. So there's income tax type increases. But what does this do? Where do the changes impact sort of charitable giving? It is likely they are going to increase the rates on long-term capital gains to be taxed like ordinary income. So why does that impact charitable giving? Well, if you sell stock that's highly appreciated, even though you've held it for more than a year, you're going to have to pay a whole lot of taxes on that. But if you donate that to a charity, they don't have to, because the charities are tax exempt. So I think you're going to see more gifts of appreciated assets to charity because it's going to be that much more tax efficient. They are talking about capping how much you can itemize to, and again, only capping for high income people. So it probably doesn't impact most of you, but I'll mention it because that's what he's talked about, at 28% if you make over $400,000 a year. What does tend to impact a lot of people is how much you can leave to your kids before the estate tax comes into play. Right now, that's at a very high level, one of the highest levels it's ever been, $11.7 million. They're talking about lowering that to $3.5 million and increasing. And right now, when you do have to pay an estate tax, the estate tax rate is 40%. They're talking about increasing that to 45%, which, by the way, is lower than what we initially anticipated. So that's actually good news. It's only going up to 45%. Now, from a gifting standpoint, they very well may reduce how much you can gift. So you have to die to take advantage of the $3.5 million number. You can't necessarily use it all during your lifetime. They're talking about maybe capping that at $1 million, which will limit some of the planning you can do when you're leaving things to your family. Why does that impact charities? Because if you're facing an estate tax of 45% plus potential state level estate taxes, so you've got your federal estate tax, which is likely to be 45%, and then you have your states, which often are going to be 16, 17%, especially if you live in Maryland or DC. That's a lot you're paying in taxes. Whereas if you leave anything over and above what you can give to your children to charity, the charities are going to get 100 cents on the dollar. They don't pay that estate tax. There's an unlimited charitable deduction. Another change which is going to impact people is they're talking about getting rid of a step up in basis. For people that don't understand the concept of basis, when you buy a share of stock, let's say 20 years ago, you bought a share of stock for $50 in Amazon, your basis was $50, and now it's worth $3,200 or whatever it's worth. When you sell that stock, you have to pay a gain on the difference between your basis and the capital gains. A lot of people have houses. So you got a house that you bought a long time ago and it's all paid off and you paid 50 grand for it and now it's worth $1 million. Well, when you sell that house, you've got to pay capital gains on that. And if you were to give that house to your children while you're alive, they have to pay capital gains on it. But if you hold on to it until you pass and you leave it to your children, you get this thing called a step up in basis, and it's like they bought it the day you died, and if they sell it the next day, there's no capital gains. And that's a big deal because a lot of people, their major assets are real estate, and real estate often with significant capital gains. And now we're talking about taxing long-term capital gains at the same rates as ordinary income. And so if you sell that house, there's going to be a huge amount of taxes. And that's not for the wealthy, that's for everyone. Now, hopefully, if they actually pass this, they allow some level of step up on that so it doesn't impact people who don't have a lot of money. But right now, the proposals as stated are getting rid of the step up in basis, which is going to hit most everyone, whether you're wealthy or not. And so again, if you've got highly appreciated assets, you want to take a look and say, well, what's the benefit of it going to my family as opposed to which is going to end up with somewhere between 55 to maybe 40 cents on the dollar to leaving it to a charity that can get 100 cents on the dollar. So those are some of the major changes to come. So what does that mean from a planning standpoint for people? Well, a lot of people are just planning. There's a lot. We're in a global pandemic, so I've had a tremendous amount of influx of people wanting to do estate planning. If they've done their plan, they want to update it, and if they haven't done their planning, they're anxious. People are feeling their mortality a little more these days, so people are doing planning, which is a good thing. So that's impacted how sort of the estate planning world's going. We're booked and behind, and I'm booking meetings pretty far out at this point. And the type of planning that we're doing, the big planning I would say that people are doing is they're taking advantage of the laws as they stand today. So as I said, right now you can leave $11.7 million to your children, and you can gift it to them if you would like to as well. So if you use up and take advantage of those laws while you're alive, even if they change the laws later, then you can lock in the use of those laws. Some of the other changes, by the way, that they're talking about doing are using, making it easier to use split interest charities or charitable donating and donations. And when I say a split interest, it's the type of interest where you make a gift to a charity and the charity gets a benefit, but you get a benefit as well. You might get a stream of income back. You could do an annuity. You could buy an annuity through a charity where you give them a lump sum of money and they give you back a stream of income for your life. Now, the charity gets a benefit from that because they're getting a bunch of money that's worth more than what they're giving back to you, and you actually get a charitable deduction for that today as well, along with that stream of income. You could also do something like a charitable remainder trust. Those are the types of things where you make a large distribution or donation to a trust, and the trust maybe gives you a stream of income back for your lifetime or 20 years or something along those lines, and then what's ever left at the end goes to charity. Those have been kept out of some of the enhanced charitable gifting rules, and they're looking at potentially loosening those up so that you can do donations to those types of tools or utilize those tools without having and fully taking advantage of the tax deductions, not having some of these lower income tax limits. Just a couple other quick things I want to mention, maybe slightly out of order, but Mark talked about bunching and how you can make gifts if you want to take advantage of itemizing, and you typically would not itemize in every year, so you want to do a bunch in 1 year. But you don't necessarily want to give it all out to a charity in 1 year. Maybe you want to dole it out to several charities. You can do certain things like a donor advised fund, which is a charity where you give them a bunch of money and then you tell them where you want them to gift it at points in the future. They're not required to do that, but they do. Otherwise, they'd go out of business. So donor advised funds are very common, inexpensive tools to use. And then if you want to be a little more hands-on, you can do a private foundation, which is another similar concept. You put a whole bunch of money into the foundation today, and that foundation isn't required to give money out until later on. You can, dole it out as you want. Okay, so I think I've used up my 15 minutes. So I'm gonna open it or pass it back to Lou, I guess, is who goes next, and we're gonna open it up to questions, I think.
Yeah, thanks so much, Dan. That was great. Good review. I mean, that's, a lot of the concepts that Dan talked about are quite, complex, and, they're, that's why you need someone like Dan to help guide you through those. But I thought before we have several questions, but I thought I might mention there are a few more tax things. I'm practice tax at my firm here. So Dan mentioned that the above the line deduction for charitable contributions is $300 this year or $600 for a married couple. But then so far that's all we know. It goes after 2021. But there are some proposals in Congress to greatly liberalize that above the line deduction to as much as $4,000 for single people and $8,300 or so for joint filers. Now, and they have a lot of bipartisan support. Now, the question you get to, is there going to be another tax bill like Dan was saying? And if there is, are they going to have any money to support these kind of things, or are they just going to want to get money on the Hill? So that's, we don't know the answer to that. But these have pretty broad support. And there's another one that would liberalize this charitable IRA deduction, that contribution that's not really a deduction, it's a contribution that Dan mentioned and Mark mentioned, and to increase that from 100,000 to 130,000 for, and also to have a more generous 400 up to 400,000 if you fund one of these charitable gift annuities that Dan mentioned. So there are proposals out there that could help a lot, if folks who are of a mind to be giving, a mind to be giving, a good amount of money to, one or more charities that they're fond of. And so, and I had mentioned to, when we were getting ready, one thing that several of my friends have told me is that what they did last year, they got the stimulus check, and, they may get another check. Maybe it's already in their account this year. Is if you feel like you really don't need that check, that's a great amount of, extra money to give to your charity. But again, and you can itemize it if you're able to itemize, but most people can't. So you need to accept up to that $300 or $600 limit. So those are just some more things out there on the horizon that, you can track the news reports and see what Congress is going to do later this year. So now we have a couple of questions from our audience. One person wants to know what the deduction is for a single person. So, and I guess, I don't know, Dan, you want to?
It's half of the married. Mark, you said it was 25.
12,550.
There you go.
What's that, Mark?
12,550.
Right.
So you have to have, it's way easier for a single individual to itemize than a married couple.
Right.
because there's this thing called state and local tax, which used to be fully deductible. And that's, your property taxes. If you live in Virginia, you got really high property taxes. You used to be able to deduct all that stuff. Now you're capped at $10,000. So if you live in Virginia and you're single and you just need to get over $12,000, a lot of those individuals are still itemizing. But married couples, not so much.
And if you're not able to itemize, then you're limited to the $300. If you're a single person, to the $300.
Unless you have an IRA and you're over 70 and a half.
Right. That's right. So that's kind of the answer to the single person's dilemma. And well, speaking of the IRA, the next question is, can you only donate from your IRA if you're old enough to have RMD requirements?
So I'll take that. Mark, you can get the next one. I know I talk all the time. So the issue is you can always take a distribution out of your IRA. And if you're itemizing, you can make that donation to charity, and that's a wash, as long as you're itemizing. Or if it's $600, and you're married, then that's going to end up being a wash for you. The change that they have is if you're not itemizing and you're taking the standard deduction, if you're over 70 and a half, you do have to be over 70 and a half in order to take money out of the IRA, have it go directly to charity, and then it's not included in your income regardless as to whether or not you're itemizing. So that's the difference.
So that's,
I would add that the IRA is just not powerful. It's not as powerful an asset to pass on to the next generation because they're going to be taxed right away on it, or they can defer it up to 10 years. So that's when you're doing your planning, you think about your IRA. It's a great place to put a nonprofit organization there as a beneficiary, a part of it.
Yeah, the way I often exemplify that is, let's say you just have two assets. You've got $1 million in a bank account and $1 million in an IRA, and you want to give $1 million to a charity and $1 million to your children. Well, if you give $1 million to your children get $1 million. You give $1 million to the IRA to the charity gets $1 million because they're tax exempt. But if you switch those two, and instead you gave the $1 million charity, $1 million cash to the charity, they still get their $1 million. But your kids that get the IRA only get maybe 50, 60 cents on the dollar. So that's why retirement assets are some of the best ways to leave to charity. And often when I have clients that are charitably inclined and they're like, I want to leave something to charity, the first place I look is, do you have a sizable retirement account, at least large enough to cover that distribution that you're looking to do?
That's good. Thanks, Dan. Yeah, a number of good. Here's a good one for Dan too. I'm sure Mark could answer these as well. But what is the difference between a charitable bequest and a beneficiary designation?
I'm happy to answer that. So a beneficiary designation is an instruction that you're going to put on an account or some type of asset like a life insurance policy. So it says, where does this asset go at my death? A bequest is normally something in your will, and wills govern assets that don't have these instructions built in. So, if you've got a retirement account says I leave it to one child, and your will says I leave it to 3 children, it's only going to the one child, or to an ex-spouse or something like that. So you want to keep your beneficiary designations up to date because those control. But if you have an asset that doesn't have instructions built in, that's what your will is going to govern. And a will is a set of instructions to these assets that are sort of titled solely in your name without instructions. And in your will, you can say, I want to leave $100,000. That's a bequest. And so it's normally something covered in your will. You could say, I want to leave my diamond ring. That would be a bequest as well of a specific asset. But basically a bequest is an instruction in a will, and a beneficiary designation is attached to the asset.
Thanks, Dan. Here's a good one for you, Mark. If you do want to comment, Mark, on what
I think that's a description of it. I think the most important part, and we do it all the time with clients, is to make sure that all those that beneficiary designations are correct, that they're up to date. Dan made a funny joke about, you leave it to your ex-spouse by accident because you have an IRA you forgot about, and that's where it's going to go. And keep in mind, as they've already described, that asset is just not as powerful as it used to be because it's got that 10-year rule on it. So it's a wonderful, wonderful place to put a donation to a nonprofit. The other part that Dan talked about are charitable remainder trusts, which we're seeing a lot of use of right now.
Mm-hmm.
So you have a stock that you bought a long time ago. Dan used the example of Amazon. It's a perfect example where it's appreciated a huge amount and doesn't pay a dividend, and you need to live off it. And so if you have to sell it yourself, you're going to have to pay a capital gain on that asset. But if you put it over into second bucket, I call that the charitable remainder trust bucket, you can sell it in that bucket, not pay capital gains on it because it's in a special place, derive income from it over your lifetime for both you and your spouse. And when you're both gone, that asset goes to a nonprofit organization or organizations if you have a bunch of people you want to leave it to. So that's a very powerful way. It's more sophisticated planning. It's one you'd probably sit down with your attorney and kind of talk about how all that work. But this is an important time that Dan talked about it, to look at things again. We've gone through a very difficult health situation. Death is upon lots of people, unfortunately. And, many people that I see, have gotten their legal documents done, 15, 20 years ago when their kids were kids. And now they're adults and they have issues or they don't have issues. So there's all kinds of planning that needs to be done now. And this is a good time to do it. You're all home and have time maybe on your hands and to make sure and have those conversations with your spouse about, what's the message going to be? And that's what we do every day with clients.
Thanks, Mark. And then can I donate, someone's asking, can I donate closely held stock like of a business I have, or does that as well to charities, or is it limited to publicly traded stock because, valuation issues and the like?
Mark, you want to take that or you want me to?
I want you to take that one. I'm not sure about that.
Okay.
I think it
So
depends
there are,
on the
actually, Lou
organization.
hit one of the issues right on the head. With a closely held company, you need to value it. So that can be a challenging asset with which to, how much is your charitable deduction going to be? And valuing a closely held company is an expensive thing to do. Often you got to get appraisals and the like.
Yeah.
Also, closely held companies are often, they might be an S corporation, but you have to look at, is the charity a qualified S corporation shareholder? So there's certain, not everyone can own an entity like that, and so you have to look at that. You also have to look at, when you start giving ownership in something closely held, some of the shareholder rights that you're dealing with. Do you want to have a shareholder agreement that so that let's say you wanted to have that company bought out, and they want to buy the whole company, and now you've got a charity that owns 5% of that. Do you want that charity to be wagging, a tail wagging the sale? So you're going to want to probably have a lot of agreements in place that control those types of issues.
Right.
I'd say it's not the best asset to leave behind to a charity, that's for sure, for what the reasons Dan talked about.
Right.
And it's complicated, and the nonprofit organization in many cases would not accept it just because it's too complicated and too risky for them as well. I mean, a lot of nonprofits don't even handle stock. And so, the Foundation for Peripheral Neuropathy is definitely ahead of a lot of other nonprofits in accepting stock donations and understanding how they work and forward thinking, which is wonderful.
Weird, and that's a great segue, Mark. How did you know? So somebody's asked, how do I get started leaving a bequest, a stock gift, or charitable gift, or IRA if I want to give this to FPN? And I think we may have a slide on that we can put up at some point. And there's also information on the foundation website that's really good. That'll walk you through, for example, if you want to do a wire transfer from your IRA, the wire information for the foundation is on there. So it's really not, it sounds complicated, but it's really not that complicated.
With regard to legacy gifting to the foundation, there's a couple things you could do, simple things. I mean, we can get more complicated as well, but simple things would be if you just wanted to make a cash bequest in your will, you would just have that as part of your estate document saying, I want to leave X dollars or X percent to the charity. And even simpler is your retirement account. So those beneficiary designations are just a form. You contact your plan administrator with a 401k, or if it's a IRA, you contact Merrill Lynch, and there's a simple form to fill out. And someone like Mark Friese could easily help you fill that out.
Yep. No, that's good. That's important too, because, well, the foundation regularly gets bequests every year. I mean, some years we get more than others, and, we want all of our donors to live forever, but we know that not everybody's going to do that. So, bequests are, very important to charities such as the foundation, and it's really easy to do those, and with your estate planner like Dan, for example, to help.
I think
So,
the other thing is that it's also multi-generational, and so lots of our planning, brings the kids involved. So if it's a large estate, and mom and dad have had it for a long time, and I got hundreds of stories like this, and they're trying to get their kids involved. The kids then learn about philanthropy, learn about giving back. I think have a better life because of that. That's my personal opinion. And so they kind of pass that charitable DNA on to their children. So those nice conversations, and professionals can definitely walk you through all the different methods that are out there, so you're making the best decision.
Some common tools for that family planning, if you're interested, is a private foundation or a donor advised fund are very good tools for that, where the parents or the grandparents are going to gift money into this vehicle, and then the kids can be involved, or the grandchildren can be involved in deciding how it gets paid out over time. And I have a lot of clients doing that, actually. And it's a great tool, because some people who are very wealthy are concerned about leaving all of that wealth to individuals and having that negatively impact their lives, and they like the concept of getting involved in charitable gifting.
Yeah, that's great. And one more practical question, Dan, and maybe Mark too, is there a minimum amount? So you'd mentioned you can put a bequest in your will. I give X dollars to the foundation for peripheral neuropathy. Does that have to, is there a minimum amount, or is at some point where it's it's complex to give?
Well, it depends on the nature of your gift. If you're leaving $100 to charity, I mean, you can write a check today. You can put a line in your will. That's not that complex, and there's no real significant administration costs associated with that. Or filling out a change of beneficiary form for your retirement account. Again, that's something that I don't think there is a minimal on that. But if you're going to get into private foundations, donor advised funds, charitable remainder trusts, some of these more advanced planning, they do have costs to setting these things up, and they also have administrative costs, and there are probably some practical limitations depending on the nature of the asset and which tool you're using.
Right. Okay.
IRA beneficiaries are all done on a percentage basis normally. So even if you didn't know exactly the amount, you could just put a percent in there. So 10% of my IRA, as an example, is going to go to these organizations I believe in. So that way, if the IRA draws down to a certain amount of money, it doesn't really matter. It's done on a percentage basis.
Right. I think that's it for the questions. I think so. You were about 10 minutes early, but if anybody, do you have any additional comments, Dan? I know we have to turn it back to Nancy for a wrap up, but Dan or Mark, any more?
Well, I certainly could start talking about all kinds of stuff. I'm just.
I know you're a talker, right? No.
Do we want to, Mark? You have any thoughts as to a quick topic we could do? 5 minutes.
I would talk about a topic called the magic number, which I talked about earlier. Is do some planning, kind of figure out what might be left over. I mean, the reason that a lot of people don't give money because they're not sure they can afford to. That magic number kind of shows you this is what's going to be left over. And Dan alluded to it very well and succinctly. Leaving a huge amount of money to your children in many cases is not a good idea. I do a whole seminar series on your kids aren't equal. Now they're all different. My son, my son has autism, so he won't be able to function on his own. So he's going to need a lot more money than my daughter's going to need, as an example. And so, when I grew up, Christmas time, everybody gets the same amount of Christmas presents. Everything was equal, and your parents treated you equally. But kids aren't equal. And so those are some, thoughts to keep in mind. And as both Dan and Lou talked about, thinking beyond yourself, thinking about what what's the message going to be? And in my office, sometimes the couple has never thought about it. And you look at the number and they go, well, $13 million, and we have one child. That child doesn't need $13 million. And what are they going to do with it? And so then they start, planning with somebody like Dan to get their legal stuff done and then start changing beneficiaries and start building a legacy.
Yeah.
It's a wonderful feeling. I mean, when they start talking about it, it's such a nice thing to do.
Yeah.
You're built that way. That's what you do.
Hi, I'm Nancy, everybody. I wanted to jump in and ask a question if I could. What about for the people who do their own taxes? Or how do they accommodate the either planned IRS withdrawals or any of the things that you all have talked about?
Well, most people are doing their own taxes these days. It's kind of like fantasy football. Back in the early 90s, when I played fantasy football, I had to wait for the Washington Post to come out and score these things by hand. Nowadays, now there's, computer programs that score everything for you. And it's the same thing with taxes. Back when I was doing my own taxes as a kid, I pulled out the forms and read the instructions and sort of calculated everything. And today people use something like a TurboTax or one of their competitors if they're doing it themselves. So from a tax preparation standpoint, most of these things, like if you make a distribution out of a retirement account, you're going to get a 1099-R from the financial institution saying that you took that out. And what you need to do is you need to make sure you make the proper election in the software. I would say the more complicated you get with this stuff, the more you should consider having an accountant do it, because if you don't, you could end up costing yourself a lot in taxes and you don't realize it. For example, you might think, hey, I've taken this $100,000 out and given it to a charity, but then I do it as an itemized deduction instead of doing it as one of these straight to charity things, because you didn't do it in the software properly. Right. And what would ultimately the net effect of that would be, you really only got a $75,000 deduction because of the standard deduction is being used up, right? And so those sorts of things I would think get a little complicated. And that really depends on how comfortable you are, I'd say, with the software. But you may want to, if you're doing some of these things, you may want to consider having an accountant do it for you.
And I would add to that you great organizations like the Peripheral Neuropathy that's giving you information. So if you're a do-it-yourselfer, I mean, you're now learning about things that are techniques that are available under the current tax code, and so you can look them up on the internet and find out about them. But unless you went and saw a professional about it, you wouldn't know about that. And people writing $10,000 checks to charities when they have appreciated securities, or people writing $10,000 checks to charities when they have an IRA account, they could be giving that asset away. That would be much more beneficial to them, more beneficial to their kids, more beneficial to the nonprofit organization. So that's what you're learning today. So I applaud you guys for putting together a program like this to show people what's out there and what are your choices.
Yeah, no, thanks, Mark. And so you'll need, Nancy's happy to help, and we have instructions on the website. And you're gonna have to contact your IRA vendor, if it's Fidelity or Prudential, whoever the IRA sponsor is. But that's easy. They have form. It really is pretty easy to get that done. So don't be intimidated by, the fact that you have to do it through the IRA.
And speaking of doing it yourself, we touched on this as well, but it is very important from just a planning standpoint that you make sure that your assets and beneficiary designations are titled the way you want them to be, or you are going to have unintended consequences. And Mark said Dan made a joke, but to give you a little story, I had a client and they didn't update their beneficiary designation on a life insurance policy, common one that many people have, Federal Employees Group Life Insurance. And it had the ex-wife still named as the beneficiary. It was the second, a second marriage sort of thing. And actually it was third marriage, so he was naming the second wife. And so we ended up having, it went to court. We had to go to court on this. Mm-hmm. And to determine, who got the money. Was that beneficiary designation still valid? And this case went all the way to the U.S. Supreme Court. And the U.S. Supreme Court took this up and said, because that's how big this stuff gets, and determined that with a federal employees group life insurance policy, it doesn't matter what your will says, doesn't matter what the states say. If you have a beneficiary designation that says the ex-wife, that ex-wife gets, or whoever it is. So it is very important that you go through these things and make sure that those are up to date. So just having a will that's up to date is not enough.
Yep.
Great. Well, I just want to thank all three of you for your insights and all of your expertise in sharing your information with us today. And as Lou said, we have a beautiful slide that I'm going to pop up here in a minute that gives information for anyone who would like to donate or make a charitable gift to FPN. Thank you. You talked about bequests. You ask your financial advisor to add this line to your will or your trust, and then contact us for our tax ID and other information. If you'd like to make a charitable IRA distribution, you go to your IRA administrator to make a transfer directly to our organization. And if you contact us, again, we'll give you all the information you need. And if you want to make a stock donation, first you determine how much, what shares you want to donate and how many. And again, we'll give you depository accounts, tax IDs, and all the other information that you need for that. And if you want to donate any other assets, we have anything on our website, you can contact us. And here's our contact information on the next slide that you can talk to Lindsay or myself, send us an email or give us a call. The other thing I will say is that Mark kindly will answer questions and work with anybody, and I'm sure Dan as well. So if anyone has any questions, if this is what you're planning as you look towards tax season, we'd love to hear from you and work with you and help support the good work that we are doing. And so with that, I'll say thank you to our guests. We really enjoyed having you here. To everybody online, we have a survey that will follow, that if you could answer that survey, give us some suggestions on this one and ones for the future. We also always need to put in a plug for supporting us, which is what this is all about. We had a huge year last year with research funding, getting through our advocacy efforts, we got a $370 million block of funds from the Department of Defense that will now include peripheral neuropathy as an eligible condition for funding for researchers that our researchers are excited to tap into. We started doing online webinars like this one. We have 1 or 2 a month on a variety of subjects. So please join us and please help us continue to do what we do. And if there's anything else we can help you with, feel free to contact us. So again, thank you for joining us this afternoon, and hope to see you all soon.
Nancy, you said you had this beautiful slide coming. I thought it was going to be our picture.
Oh, we have that already. That was the first slide we started. So anyway, thank you very much.
That's great. Guys, thanks for listening, and thank you for all you do.
Yeah.
Thank you.
Bye-bye.
Bye-bye. Thanks, Dan, Mark, and Nancy.